You might have seen many blockchains with staked value or locked capital supporting their security and DeFi systems. Such blockchain networks need to use a consensus mechanism, for example, proof of stake, where the staked capital enables them to provide secure and useful services to users. But have you ever wondered how new emerging blockchains attract, retain, and build their capital base to support their security and DeFi systems? You see, at its core, every blockchain is simply a database of transactions, which are verified and maintained by a distributed network of computers. These computers coordinate to agree, confirm, and validate these transactions with the help of consensus mechanisms. These computers are maintained and operated by operators. But how do these networks actually achieve consensus? One such mechanism is proof of stake, where users, typically called stakers, lock up, stake some capital, or as we say, stake their assets, to indirectly vouch for the quality of the services provided by those operators, ensuring network security and operational integrity. Honest or sincere work gets the operators and stakers staking rewards. Dishonesty or maliciousness can lead to slashing penalties on an operator's and their stakers' locked capital. Do good, get rewarded. Go bad, lose your stake. Sounds about fair, right? The risk of slashing the locked capital incentivizes operators to behave appropriately, and the locked capital becomes a source of economic security guarantee for the network. But how does an emerging network acquire staked capital to build a strong decentralized economic security? Without compelling economic security, it would be hard to attract users, as users would not like to use a network that does not have strong security guarantees. Without users, there is a struggle to attract staked capital to offer stronger security, as stakers would not prefer to secure a network that has little user adoption and cannot distribute compelling rewards. It's your classic chicken and egg situation. So which comes first, the staked capital or users? The bottom line is, proof of stake blockchains need staked capital for security. Nowadays, with more and more proof of stake blockchains entering the space, attracting capital becomes increasingly complex and competitive. Where simple short-term incentives could be effective earlier, that's simply not a sustainable strategy today. However, blockchain networks today are evolving beyond merely acting as smart contract platforms. Let's take the example of Supra. Supra itself is a multi-purpose network providing services like smart contract transaction processing, bridging and cross-chain communication, native Oracle services, enshrined automation capabilities, and even an integrated cross-chain automated market maker, which enables cross-chain value exchange. To ensure the security of the first four services, the system needs to attract staked capital. Additionally, to enable the functionalities of the cross-chain automated market maker, Supra also needs to attract liquidity. This creates an interesting problem and an opportunity. First, as a proof-of-stake network, Supra needs to attract staked capital to secure the network. Secondly, Supra also incorporates a value exchange mechanism, the AMM, that facilitates the conversion of one asset into another. The AMM needs to attract a collection of digital assets to its liquidity pools to facilitate value exchange, with the help of people like us taking up the role of liquidity providers by locking up our capital in smart contracts. Once this capital is acquired, the AMM utilizes it to facilitate asset exchange. Now, let's explore how the AMM performs this conversion. If a user wants to convert asset A to asset B, the AMM needs to have asset B in its reserves. This allows it to take asset A from the user and give them asset B. Therefore, without capital in these reserves, the AMM cannot facilitate the exchange of assets. Now, for each conversion, the AMM charges a small fee from the users. Since acquired capital is very valuable, the AMM shares a portion of these fees with the capital providers who support the AMM's operations, as a reward for their contribution. This creates a mechanism for the AMM to facilitate financial transactions, whereby liquidity providers earn a share of the fees that users pay. But wait, doesn't this create another dilemma? Yes. AMMs also often face a chicken and egg problem, similar to that of the proof-of-stake mechanism. They require a critical amount of liquidity to be operational and to attract users. But capital tends to go to AMMs that already have a significant number of users, ensuring that liquidity providers receive a significant amount of fees collected from those users. AMMs need capital to be operational, but they need to be operational to generate fees and attract capital. So, speaking about the two chicken and egg problems, what should come first for a secure and operational proof-of-stake blockchain network? Staked capital, or users. And what should come first for an operational AMM? Liquidity, or users? With these questions being front and center, one thing is clear. The success of both the AMM and the underlying POS blockchain network is directly linked to the amount of locked capital it can attract, and to the sustainability of incentives a network distributes to attract capital. Let's take a closer look at what we mean by capital here. The kind of digital assets we attract matters a lot here, because there are many such assets out there, all with varied risk characteristics. And not every asset equally contributes to Supra's objectives of efficiently increasing the economic security of the network and creating a competitive AMM. For a POS network such as Supra, you want the staked assets to maintain their value. If the staked assets lose their value, it directly impacts network security, as there would be less total value securing the network. So the network would want to attract assets that are not significantly at risk of devaluation. Furthermore, it might be in the network's best interest to attract multiple assets, forming a diversified portfolio that, in total, carries a lower risk of devaluation. It does not necessarily need to be secured via a single asset, which is the case with most proof-of-stake blockchains today. To sum it up, a diversified asset portfolio that can maintain its value over time can contribute to establishing stronger economic security for a proof-of-stake network, when utilized as a staked asset base. But what about the AMM? On the AMM side, the system needs assets in the liquidity pools that users actively utilize. For example, let's take asset A and asset B. If many users wish to convert asset B to asset A, then asset A is in great demand. So if the AMM possesses more of asset A in the liquidity pools, it can more efficiently facilitate the exchange, creating value for the users. Therefore, attracting more of asset A helps the AMM meet its objectives. Additionally, the system's need for capital may also change over time. If the network experiences low user demand for value exchange, a significant amount of capital attracted to the AMM would merely remain in the liquidity pools, unused. Therefore, if we have a fixed amount of incentives to distribute to attract this capital, we need to use them efficiently over time. So during periods when the AMM experiences higher demand from users, the system could distribute more incentives to attract more liquidity and meet this demand, and it could distribute fewer incentives during periods of low demand. So to optimize the utilization of limited incentives to facilitate the success of the AMM, these incentives should be applied to attract capital in digital assets that are in high demand and to attract those assets at the right period of time when they could be effectively utilized by the users. This can create a robust and sustainable economic model for our AMM. Now, this is an interesting problem where the needs of both the POS security system and AMM may seem independent of each other. But what if they could work together to deal with the challenge of bootstrapping capital across both systems? Generally, POS blockchains like Supra often seek to attract staked capital solely in their own native token. However, could the capital submitted to AMM liquidity pools help diversify the asset base applied to ensure the economic security of the network? In other words, what if we could support the network's POS security with the liquidity attracted to the liquidity pools of AMM, while channeling staking incentives towards making a stronger case for attracting in-demand assets to the liquidity pools? Such a system can help liquidity providers submit capital for AMM liquidity, and then apply the same capital to support the economic security of the blockchain as well, making the risk-reward balance tip in the right direction for them. That's a very simplified version of Supra's answer to both of chicken and egg dilemmas. Their proof of efficient liquidity protocol, which aims to create sustainable incentives for attracting capital by using it more productively across all systems of the network. Let's take a closer look at PoEL. This is a framework of financial programs and incentives designed to help proof-of-stake blockchains like Supra with native DeFi applications bootstrap capital efficiently. When we say efficiently here, it's all about attracting the right digital assets with a limited budget over a long period of time. In other words, creating attractive incentives for capital by boosting its productivity within the system rather than resorting to short-lived tactics like APY boosts and whatnot. At its heart, the PoEL protocol can be understood as a money market system with a single lender, the Supra network itself, and a single asset that can be borrowed, the staking token of Supra. After borrowing, staking for network security is the only action borrowers can take with Supra's tokens. Let's take Jen for example. Jen comes across Supra's PoEL protocol and decides to check out its dual rewards. She deposits capital into the liquidity pools of Supra's native AMM, and receives liquidity provider tokens, or LP tokens for short, which represent her share of the liquidity pool. These LP tokens can then be used as collateral for borrowing the native staking token of Supra. She can now stake the borrowed Supra tokens in Supra's proof-of-stake scheme to back the network's security. An important thing here is that Jen can't use these borrowed Supra tokens for anything else. So she goes ahead and selects a service provider or an operator to delegate her Supra tokens, which is as good as vouching for the quality of the operator's service. In case this service provider fails in their duties, Jen will face a penalty and lose a portion of her collateral from the liquidity pools. However, if the service providers perform correctly, Jen stands to earn staking rewards, aka block rewards, while also earning AMM fees for the liquidity she added to the liquidity pool. That's how PoEL helps Jen gain income from two sources with the same capital. Now let's understand how the PoEL protocol functions and get a bit more technical, starting with the economic security side. We've already seen that the network would want to attract a diverse range of assets that are not significantly at risk of devaluation to optimize Supra's economic security and minimize systemic risk. Through the collateralization rate, the PoEL protocol incentivizes Jen to submit these types of assets to the AMM liquidity pools, then use them as collateral to borrow Supra tokens and stake them in the proof-of-stake scheme. The collateralization rate determines the amount of Supra that can be borrowed using specific assets placed in AMM liquidity pools as collateral. Strong assets that can help strengthen the network's security guarantees and decrease systemic risk would have lower collateralization rates, allowing Jen to borrow and stake more Supra, earning more staking rewards. Similarly, assets that potentially increase the system's instability would carry higher collateralization rates. This naturally motivates Jen and others like her to bring the right kind of assets to the system, contributing to risk minimization for the network. In essence, this protocol aims to attract assets that assist the Supra network in meeting its security objectives. But what about the AMM side of the story? The objective on this side is to attract assets that users want to utilize to the AMM's liquidity pools. However, the demand for utilizing the AMM and the assets held in the liquidity pools is never fixed. It changes over time. This is why PoEL dynamically manages the staking rewards budget. Let's understand this with Alex and Mark, taking them as the only users of Supra's AMM. Say Alex and Mark used to exchange A and B, but now they're trading smaller amounts, possibly due to the overall crypto market trend. The AMM's need for liquidity pool reserves of these assets to facilitate exchanges also reduces. And let's assume that such a decline in usage has also been experienced with all other asset pools supported by the AMM. So when the AMM sees a trend of decline in demand, the PoEL protocol also starts reducing the budget for staking rewards available to participants in the PoEL protocol to save resources for more active times. So if Jen adds assets A and B to the AMM liquidity pools, borrows staking tokens, and stakes them during this period, she will receive relatively smaller staking rewards. This discourages her from contributing large amounts of capital that might remain idle in the AMM liquidity pools. On the other hand, when Alex and Mark start to show a growing demand for converting between these assets, requiring larger reserves to support these conversions and future demand, the PoEL protocol starts increasing the total budget for staking rewards for capital contributors. This encourages more participation in the PoEL protocol and capital contributions. In such times, the AMM itself naturally generates more fees, further motivating participation, and that's consecutively amplified by the PoEL protocol. So if Jen contributes her assets to PoEL during this period, the total reward she earns would be relatively higher. Therefore, when the system needs more capital to meet the rising demand from users, Jen is more likely to contribute more capital. The PoEL protocol algorithmically regulates and optimizes how staking rewards are distributed across different periods based on user activity trends. It does this in a fully decentralized way, ensuring the sustainability of the incentives given out. We have now determined the total staking rewards that can be distributed at different times. However, the protocol also needs to decide how to allocate the available reward budget across various assets, as not all assets are equally valuable, as mentioned earlier. This allocation is managed through variable interest rates. Here's how it works. Imagine Alex and Mark want to convert asset C into asset A and asset B. They prefer converting asset C into asset A more than into asset B, leading to a higher demand for asset A's reserves than those of asset B. The PoEL protocol considers this aspect when allocating rewards. It employs a variable interest rate mechanism on staking rewards earned on the borrowed staking tokens for this purpose. By applying varying interest rates to the staking rewards distributed among contributors of different assets, which may also be negative, it directs a greater share of the total rewards to liquidity providers of asset pools with lower interest rates. If the interest rate is negative, it means asset contributors are granted additional rewards rather than being charged interest. Therefore, contributors of asset A, like Jen, receive higher rewards as opposed to those of asset B. So how does this ultimately play out for Jen? Well, liquidity providers like Jen can just look at the yield generated for different assets to determine which asset to contribute to the pools. And the AMM fees, collateralization rates, staking reward budget, and variable interest rates add up to determine the yield generated by an asset, naturally bringing the most desirable assets to the system. Whenever the system indicates demand or desirability based on the offered rewards, she can also allocate additional capital. That's how the PoEL protocol extends the utility of the capital in the AMM liquidity pools, applying it to also ensure the network's economic security, while offering dual income to capital providers like Jen. Its unique incentive program and set of dynamic rates effectively attract the right mix of digital assets to the liquidity pools, which helps optimize risks and enhance user experience. This ultimately boosts the economic security and reliability of the Supra network as well. So far, the PoEL protocol has solved two problems, which are like the chicken and egg problem, allowing the blockchain to not only attract capital to secure the network, but also help users utilize the same capital to provide liquidity for the AMM. But what about the multiple essential developer services that Supra provides natively on its blockchain network? We've seen that Supra vertically integrates smart contract platforms, cross-chain communication, oracles, DVRF, and automation services, all in one blockchain. While this stands as a unique offering for Web3 developers, attracting initial users can still be a challenge. Without initial users, the network might struggle to achieve network effects, leading to fewer incentives for new developers to build on the network. Also, there's a risk of the network's infrastructure not being optimally utilized, as a small number of users can lead to underutilization of the assets submitted to the liquidity pools, compromising the network's objectives. So can we continue attracting more capital, but also somehow incentivize new users, compel time-sensitive usage of the network? This is where service fee credits come into the picture, PoEL third incentive. To better understand service fee credits, let's say Jen plays a game deployed on Supra, or she is the game developer herself. Now we know that when Jen submits capital to Supra's AMM liquidity pools, she can both earn DeFi fees and staking rewards with the PoEL protocol as usual. But now she can also be granted special service fee credits. These service fee credits can then be used to avail services offered by Supra to build her game. So if she needs Oracle data feeds or verifiable randomness for her game, she can use the service credits earned through PoEL to practically avail these services for free. That's an additional reward. Of course, these credits are designed to incentivize usage of Supra's services. They're non-transferable, time-bound, and can only be used for Supra services by design. So Jen cannot sell or trade these credits in any open market or hold on to them forever, which ensures incentives while rewarding users, and also helps sustain the network. If Jen does not use them within a period of time, her service fee credits will expire. So as soon as Jen earns these credits, she is incentivized to use them, driving timely utilization of the network's resources. And since these credits further help increase Jen's earnings, she will now have 3 sources of income, which will help Supra achieve network effect with users and capital. By the way, these credits are not unlimited. The PoEL protocol strategically distributes a limited number of credits over fixed periods of time to drive usage and attract capital, especially during the early bootstrapping stage of the network. As the network grows and achieves network effects, the number of credits being distributed will decrease. This also incentivizes users to jump on the Supra ship ASAP. Furthermore, the PoEL protocol maintains its goal to attract the right type of assets at the right time, offering more credits to contributors bringing in-demand assets. Additionally, more credits are distributed during periods of higher demand, or when the network is in greater need of capital. So the PoEL protocol strategically distributes its limited incentives to motivate Jen to bring the right type of assets to the system at the right time. Being prudent about her assets, Jen cares about her capital, where it goes, and how it's used. She notices that Supra is doing everything it can to maximize the utility it can derive from the capital she has brought to the network. This utility maximization is what stands out about the PoEL protocol to Gen, as well as the entire community. This utility maximization of every unit of capital in the Supra network will initiate a self-reinforcing cycle where Supra's core native AMM seeks to attract diversified risk capital to enable on-chain value exchange, which can also secure the network. Maximal utility delivered on each unit of capital attracts further capital. In the background, PoEL protocol takes care of the more intricate details like balancing risks and rewards. And while we've discussed cross-chain AMM as a DeFi application use case so far, PoEL protocol can be applied to also bootstrap liquidity in other native DeFi protocols, such as lending protocols and insurance markets. To sum it up, Proof of Efficient Liquidity is a protocol designed to solve the chicken and egg problem faced by emerging networks by focusing on maximizing the productivity of every unit of capital the network attracts. This is not a new consensus mechanism, it's simply an auxiliary layer for POS blockchains with natively integrated DeFi applications. It doesn't just help sustain their network, but enhances it over a period of time by focusing on causal economic factors that are at the heart of cryptonomics. This framework helps digital asset owners seek attractive returns on their locked capital, helps the AMM bootstrap liquidity, helps the network mitigate asset-specific risks, and boost the amount of transactions. In doing so, it offers a system of improving risk-adjusted returns generated for every unit of resources or capital within the network. It helps your DeFi liquidity attain maximum productivity, optimizing risk and returns. At the same time, it efficiently bootstraps capital for both DeFi systems without paying out outsized or unsustainable rewards. That's what Proof of Efficient Liquidity is all about: budgeted and risk-conscious incentivization which asserts sustainability. Because sustainability matters.